Assalamu alaikum and good evening to everyone. Let's just start. Let us try to complete the remaining concepts of investment appraisal topics. In our first class, we have seen NPV, IRR, payback period, and return on capital employed as well. Now let's discuss quickly sensitivity analysis. Basically, we know that if NPV is positive, then obviously we say we should opt the project, because if NPV is positive, it will increase the wealth of the shareholder. So on that basis, we should opt the project. But can I say, for example, assuming the project is having a positive NPV of 2 million, can I say the positive NPV of 2 million, which we have calculated, there's no guarantee that if someone makes an investment is going to have the NPV of 2 million. It could be different than 2 million. Why? Because while calculating NPV, we have used everything which we have used, everything was your estimates. An estimate can change. So which means that even the NPV is positive, but there's no guarantee that after making an investment, you are going to have the positive 2 million NPV. Because estimates can change, and due to change in estimate, there's a possibility, in fact, instead of having positive NPV, project might generate a negative NPV. So that is why we introduce a technique. The name of the technique is sensitivity analysis. Actually, sensitivity analysis gives you the information that how much adverse change in estimates will make NPV zero. Repeat. What does sensitivity analysis do? It gives us the information that how much adverse change in the variables will make NPV zero. Now the concept, listen, very important concept. The smaller the adverse change makes NPV zero, it means the project is very risky. For example, assuming if the results of the sensitivity analysis are, let's say, if the selling price reduces by 10%, then NPV becomes zero. For example, if the variable cost increases by 5%, then NPV becomes zero. For example, additional fixed cost, if it increases by 12%, then NPV becomes zero. It means we can at least say that project is more riskier at variable cost. So the smaller adverse change, the smaller the adverse change in variable, which makes NPV zero, it means project is more riskier at that point, at that variable. Okay. Now, before applying sensitivity analysis, organizations should know one thing, that there are limitations in sensitivity analysis. What are the limitations? Number one, actually, when we apply sensitivity analysis, so at a time it is applicable only on one variable, and it assumes all other variables are constant. Practically, this is not the case. Because if we are saying that selling price will reduce, then the law of demand should prevail and the sales volume should increase. So the sensitivity analysis is having limitation. One of them is, at a time, sensitivity analysis is applicable only on one variable, and it assumes all other variables are constant. Second limitation, sensitivity analysis does not give us any decision criteria. The question is, what do you mean by decision criteria? Let me give you the example. If there is one project in front of you which is giving you a positive NPV, then the decision criteria is, if there is, I'm just explaining the decision criteria. Yeah, don't worry at all. If there is a single project in front of you, if that project gives you the positive NPV, then simply we opt that project because it will increase the wealth of shareholders. If there are 10 projects and out of 10 you need to opt only one, so obviously you are going to opt the project which gives you the highest NPV. That is a decision criteria. But the problem with the sensitivity analysis is it does not give us any decision criteria. For example, if the selling price reduces by 10% and NPV becomes zero, Now the question is, should we make investment or not? Sensitivity will give you no answer. So there are two limitations in sensitivity analysis. Number one, at a time it is applicable only on one variable and assumes all other variables are constant. Second, does not provide any decision criteria. Now let's see, how do we apply sensitivity analysis? Let's say if we are applying sensitivity analysis on the selling price, definitely if selling price reduces, there is an adverse change and that will make NPV 0. How will you calculate sensitivity percentage? So sensitivity percentage is equal to NPV divided by present value of sales into 100, so that you should have the answer in percentage. Variable cost. Obviously, increase in variable cost is an adverse event. How we will calculate sensitivity percentage? NPV divided by present value of variable cost into 100. Fixed cost. We are talking about additional fixed cost. We know that existing fixed cost is irrelevant. Increase in the fixed cost is an adverse event. So how we will calculate sensitivity percentage? You will take NPV divided by present value of fixed cost into 100. Okay. Sales volume. Sales volume. Obviously, decline in sales volume is an adverse event. How we will calculate sensitivity percentage? NPV. Okay. What should come in the denominator when you are applying sensitivity analysis on sales volume? Students, what should come in the denominator? Present value of what? Please quickly reply. Okay, let's see what is the answer. Contribution, perfect. Because when the sales volume reduces, your sales as well as variable costs both will reduce. And the output of sales and variable cost is the contribution. So present value of contribution. Now listen and listen carefully. If NPV is after tax, then all variables which are in the denominator, all variables will be after tax. For example, then in the denominator, you will take present value of sales after tax, present value variable cost after tax, because if the numerator, which is NPV, is after tax, then the denominator has to be after tax. Okay, if you are applying sensitivity analysis on cost of capital, obviously when cost of capital rises, then NPV becomes 0. Sensitivity percentage. IRR minus cost of capital divided by cost of capital into 100. We know that when your IRR increases and it reaches till IRR, when cost of capital reaches till IRR, then obviously NPV becomes 0. Okay. What if you are applying sensitivity analysis on project life? What should be the formula? Quickly, students, please. We are applying sensitivity on project life. What should be the formula? Quick, please. We are applying sensitivity analysis on project life. What should be the formula? Waiting. We are applying sensitivity on project life. What is the formula? Okay, let me give you a hint. If the project life reduces, then NPV becomes 0. If the project life reduces, then NPV becomes 0. Now think, what should be the formula? What is the project life? Okay, just give me the answer, please. At what point? At what point every project has NPV 0? I'm talking about the life. What is the lifetime of every project where NPV becomes 0? What is the lifetime of every project? Okay. You people know the answer, but you're not telling me. Let me tell you. Okay. Can you guys just give me the name of a technique which gives you the information when your initial investment will be recovered? What is the name of the technique which gives you the information when your initial investment will be recovered? Name of the technique which gives you the information when your initial investment will be recovered. Yes. Now listen and listen carefully. If the project life reduces to discounted payback period, logically, can I say discounted payback period is the time period where NPV will be 0? Yes or no? Discounted payback period is the time where project is having NPV 0. Is this clear to everyone? So if your project life reduces to discounted payback period time period, then your NPV becomes 0. So logically, at discounted payback period, NPV will be nil. Is this clear to everyone? At discounted payback period, NPV will be nil. Great. Now let's move. Let's talk about capital rationing. Actually, capital rationing is the situation where due to lack of funds, due to insufficient funds, organization obviously cannot opt all the projects with positive NPV. Repeat, capital rationing is a situation where due to insufficient funds, organization cannot opt all the projects with positive NPV. Normally, we have the understanding if the project is producing, if the project is going to give you the positive NPV, you should opt the project because it will increase the wealth of the shareholder. But for opting that project, we need to have the funds as well. So capital rationing is a situation where due to lack of funds, due to insufficient funds, entity cannot opt all the projects which are giving positive NPV. Now there is a question. The question is why companies they face capital rationing? What is the reason of facing capital rationing? The answer of if somebody is asking you what are the causes, / types of capital rationing. Both question will have the same answer. Normally, this is not the case, but only over here it is the case that both question will have the same answer. Causes / types of capital rationing. Actually, what causes that the situation where entity is having insufficient funds and they are unable to opt all the projects as positive NPV? The answer is there are two types of basically capital rationing. One is soft capital rationing. Soft capital rationing means organization is facing capital rationing problem because of their policies. For example, let's say organization does not want to finance the project through debt, even though the debt is available. That is very important. Debt is available, but entity does not want to take loan to make investment. So it means now due to they do need finance, but they don't want to go for debt finance. Another example could be, let's say organization does not want to issue shares to raise finance to opt the projects. Because organization is reluctant, organization thinks that if we issue the new shares, it will dilute the control. If somebody is asking the company why not to issue the right shares, because if you issue the right shares, it will not dilute the control. Then the entity says, no, if we issue the right shares, it will decrease the EPS. So simply, if you don't want to raise the loan to make an investment, even though the loan is you can raise, if entity is reluctant to raise the debt to make an investment, if entity does not want to issue the shares, it means these are the examples of basically soft capital raising. Another example of could be of soft capital raising is that organization has decided they have decided the capital budget limit. An entity has made a decision that we are not going to exceed our capital budget limit. Even though they have finance, but they're saying no, this is the limit. Let us make investment within that limit. So these all are the examples of soft capital rationing. So one reason of facing this capital rationing could be soft. Another is hard capital rationing. Hard capital rationing means due to external factors, entity is facing this capital rationing issue. Examples of hard capital rationing. Number one, let's say, for example, poor credit rating. If entity is having a poor credit rating, so obviously they will not be able to raise finance externally, or they will be facing problems to raise finance externally. It will not be easy to raise the finance for them due to poor credit rating. Another example of hard capital raising could be financial crunch in the market. What do you mean by financial crunch in the market? For example, banks, if they do not have the lending power, if for the way back in 2008 it happened, number of banks they went bankrupt. So if let's say there's a financial crunch in the market and banks they do not have the lending power, your company is willing to take the loan to make an investment, but the banks they are saying no, we don't have the lending power. So that is another example of hard capital raising. Another example could be the share price of the organization is very depressed. So they know that if we issue the new shares, nobody is going to subscribe. So these are the examples of hard capital raising. So if examiner asks you a question, what causes capital raising? The soft capital raising means which exists due to organization's policies. For example, company does not want to raise loan to make investment, even though the loan is available. Banks, let's say they are willing to give you the loan, but entity says no. We will only invest from our retained earnings. If we have the finance, we will invest, otherwise not. Another example could be organization has decided the limit for they have decided a capital budget limit. They don't want to exceed that capital budget limit, even though they can, but they don't want. So these are the examples of soft capital resting. Now, capital resting can also be differentiated on the basis of time period. What is that? If we are having a single period capital resting, single period capital resting means the problem of capital resting will be resolved within less than equal to 12 months. Single period capital resting means the problem of this capital resting will be resolved within 12 months. And in financial management paper, we have a single period capital resting. There is another capital resting also, multi-period capital resting. Multi-period capital resting means this soft capital resting problem will be resolved, but it will take more than 12 months. When we say it will take more than 12 months, it means there is no limit. It could be 24 months, 36, 15, 18, whatever it could. It could be any time period, but it will be more than 12 months. So it means you will keep facing this problem of capital resting for more than 12 months. So that is multi-period capital resting. In financial management paper, we have single period. Now listen, in single period capital resting, when we go towards project mix, for deciding, for preparing project mix, we use profitability index. We use profitability index when all projects are divisible. When projects are divisible. If somebody asks you a question, what about the multi-period capital resting? Actually, in multi-period capital resting, we do prepare project mix. But the name of the technique which we use in multi-period capital resting, that is linear programming. But obviously, that is not in your syllabus. Okay, now let us discuss few other terminologies which are used in this topic. Number one is divisible project. Actually, divisible project means projects which can be accepted partially. If I say divisible project, it means project can be accepted. Let's make it divisible. If the project is a divisible project, means can be accepted. Partially. If I quantify this, it could be within a range of 0% to 100%. If you don't want to invest, don't invest 0%. If you want to invest in 20, if you want to accept this project 20%, you can do that. 50%, 60% is up to you. It's a divisible project. Like you people might have seen a building where there are a number of flats. Let's say if there's a building which has number of flats, that's a divisible project. If you want, you can buy one flat. If you want, you can buy more than one flat also. So it's up to you. Either you want, you can buy the whole story. It's a divisible project. Can be accepted partially. We do have indivisible projects also. Indivisible project means cannot be accepted partially. Cannot be accepted partially. For indivisible, if I quantify it is 0% or 100. If the project is indivisible, either do not opt. If you want to opt, it must be 100%. If projects are mutually exclusive, mutually exclusive project means rule of or. If 2 or 3 projects, let's say they are mutually exclusive, then you can only opt one. Mutually exclusive projects means rule of or. If I say non-mutually exclusive, then you have rule of and. Okay. Now listen and listen carefully. If all the projects are divisible, if all the projects are divisible, if all the projects are divisible, then project mix is prepared by using profitability index. Actually, if the projects are divisible, what do? We calculate profitability index of each and every project, and then we opt the project which gives us the highest profitability index. Formula. NPV divided by initial investment. If you multiply this with 100, then answer will come in percentage. If you don't want to multiply with 100, it's up to you. Even you are taking present value of net cash flows divided by initial investment is still, there will be no difference on the ranking, okay? The order will remain same. So profitability index simply NPV divided by initial investment. The project which has the highest profitability index, that is going to be number 1, then 2, 3, 4, and so on. Okay. If all the projects are indivisible, then project mix will be on the basis of absolute NPV, on the basis of absolute NPV. If your examiner says all the projects are divisible, then you will be, all the projects are indivisible, then you will be deciding the order by using absolute NPV. We have another term also, that is slack unused funds. When all the projects are divisible, when all the projects are divisible, then slack is always 0. Because if all the projects are divisible, it means even a single penny will not be left, it will also be invested. Slack means unused funds. When all the projects are indivisible, then slack will exist. Then there are, I would say, more chances. Normally, slack will exist normally. Normally, this is the case. Because when all the projects are indivisible and you have limited funds, so obviously you're not going to opt each and every project. So there will be some of the cash will remain as unused. Let's apply this on a very quick question. Investment, let's say 1 lakh, 150, 180. NPV, let's say NPV is 41,400. That is 22,500. Let's say that is 20,000. Available funds, $300,000. Prepare project mix A. All the projects are divisible. B. All the projects are indivisible. So you have 8 to 9 minutes. Please quickly solve. Let's see what project mix you people are making it. Do we have the option to pause the video? Okay, I have resumed the recording. Let's see what is your results. You can compare your answer. Let's solve together. I'm solving here. Just calculate profitability index. What do we do in calculating profitability index? Simply NPV divided by investment. Okay, we got the answer of NPV 64,408. Okay, that's great. Let's see. So simply NPV divided by investment. So if I divide NPV with the investment, can I say I'll get 0.2? NPV divided by investment. So how much we are getting? 0.15. That's great. And then 0.23. 0.23. Let's see the order. Number 1, 2, and 3. Now let's make the project mix. So number 1 is going to be C A, B. Investment. Project C. C needs investment of 1,80,000. It will give you the NPV of 41,400. Project A needs investment of 1 lakh, gives you the NPV of 20,000. Now, we have available funds 300,000, but we have already invested 280. So balancing figure is 20,000. Since all the projects are divisible, so we can invest this 20,000 in project B. And project B, look at this, project B actually requires investment of 150. If you invest 1,50,000 in project B, then you will be getting NPV of 22,500. Since we are accepting project B partially because we don't have more funds, so NPV will also be partially. So 22,500 NPV is possible if you invest 1,50,000. But we are investing how much? 20,000. So let's see how much NPV we will get. It is 3,000. Yes or no? Please, students, you can confirm. $64,400. If I ask what is the NPV per dollar invested, NPV per dollar invested, simply will take 64,400 divided by 300,000. This will give you NPV per dollar invested. Dollar 0.214, okay, 7 per dollar one. It means by investing $1, this organization will be generating NPV of 0.2147. Now part B. In part B, all the projects are indivisible. When all the projects are indivisible, then we will be making the project mix on the basis of absolute NPV. So simply first write ABC. Now I only need NPV. 20,000, 22,500 and 41,400. Order. First, second, and third. When all the projects are indivisible, then you will be making the project mix. You will be deciding the order by using absolute NPV. Now, project mix. Projects, investment, NPV. So number one is going to be C. Investment is 180. NPV will be 41,400. Okay. We have opted this. Yes or no? Can I say the number two is B? But there's one problem. Okay, students, tell me what is the problem? Even though the ranking says the second project is project B, Why can't we opt project B? Please quickly reply. Funds, yes. We have insufficient funds. Projects are indivisible. Even though order says the second project should be B, but we cannot do that. Reason we don't have enough funds. So we will go towards, can I say A? Is that clear? It means we have invested 280, generated the NPV of 61,400. So if I ask what is the NPV per dollar invested? And what is the amount of the slack? Can I say 20,000? Yes. It is 20. Just 1 minute break. Azan is happening. Just 1 minute. Only. Okay. Now, very important concept. For example, we have projects A, B, C, D, E, and that's it. These are the projects. Okay. All are divisible. Let's say all are. We know that when all the projects are divisible, then we prepare project mix on the basis by using profitability index. Okay. Now listen and listen carefully. I'm just assuming, I'm just telling you the profitability index. Let's say the profitability index of project A is 0.4, B is having 0.6, C is having 0.8, 0.65, and let's say 0.70. Okay. These are the profitability index. I'm just giving you the, well, for example, we have calculated and these are the answers. Okay. Examiner says one more thing in the question. Let's say he says that project, let's say examiner says project uh, C and E. Project C and E are mutually exclusive. We have calculated profitability index of all the projects. Okay. And the examiner says that projects C and E are mutually exclusive. We know that if the two or more projects are mutually exclusive, we can opt only one. Now listen. Let us decide the order. C and E are mutually exclusive. Okay. So the project which is the highest, that is C. First. Okay. Now listen. Can I say C and E are mutually exclusive for 0.7? It cannot be second for me. Why? From C and E, I have to choose only one. From C and E, I have to choose only one. So can I say C is more profitable than E? So simply, project C is preferable. Is this clear to everyone? What are we doing? Because the two projects are mutually exclusive and projects are divisible. That is why we calculated profitability index to decide the order. Once you have decided that C is more profitable than E, then obviously C will not come. E will not come. So now what should be the second number? Is this clear to everyone? Thanks a lot. Thanks a lot. Thank you. Thank you. Now let's discuss lease or buy decision. Let's discuss lease or buy decision. Number one is investment decision. Actually, if the project is giving us positive NPV, then obviously we are going to make investment. So the first entity will have to make an investment decision. Do they want to make investment? The answer is yes. Then the second question is source of finance. And the source of finance here is, should we take the same asset on lease or should we buy the same asset? Now listen and listen carefully. How do we buy the asset in this topic? Actually, we take loan to buy the asset. We take loan to buy the asset. So actually, we need to decide which source of finance is cheaper for us, either the lease or buy. Let me clear again. The buy means entity will take the loan to buy the asset. So buy means borrow to buy. So actually we have to make the decision. Which source of finance is cheaper for us? So you have to calculate NPV of the lease decision. How do we calculate? We'll see the factors. You have to calculate the NPV of borrow and buy decision. Obviously, we are calculating NPV of source of finance, so NPV will be negative. We are going to opt the project which will have a lower negative NPV. Lower negative NPV means there will be a cheaper source of finance. For example, in case of lease, if your answer is negative 40,000, and in case of borrowing, assuming your answer is negative 42. So I'll go towards negative 40. So how to make the, how do we calculate NPV of lease decision? How do we calculate NPV of borrowing decision? We will continue, but I have to take a prayer break. So I'll be back within half an hour, inshallah. But I'm not closing I'm still online. Just pausing the video. So if you want, you can go offline. It's up to you. Otherwise, inshallah, within half an hour, I'll be back, inshallah. Okay, let's now discuss how do we calculate NPV of lease decision and NPV of buy decision. What are the factors which we need to consider? NPV of lease decision. So while calculating NPV of lease decision, number one, you will have to take outflow of rental payments. Outflow of rental payments. Second, due to these rental payments, you will be saving the tax. So tax savings from rental payments. Tax savings from rental payments. Now listen and listen carefully. I would say most of the time what happens, most of the time, not always, but most of the time what happens, rental also includes the impact of maintenance also. Obviously that particular plant needs maintenance also. So normally a rental payment will be inclusive of that maintenance. So normally that we'll discuss later on. Okay. See, outflow of basically rental payments normally they include the impact of maintenance. Normally they include the impact of maintenance. If specifically examiner says specifically that in addition to the rental payment, you will have to bear the maintenance cost also. Only in that case, there will be an outflow of maintenance cost and then there will be a tax saving from maintenance cost. But examiner has to write categorically, clearly, that in addition to the rental, you have to bear the maintenance cost, which I'm telling you normally does not happen. Because normally when we are paying the rental, it includes the impact of maintenance. But for the safe side, let me tell you again, if question specifically clearly mentions that in addition to the rental payment, you have to pay the maintenance cost also. So there will be an outflow of maintenance cost, and due to that maintenance cost, you will be saving, there will be tax saving as well. Otherwise, most of the time when we calculate NPV of lease decision, there will be two things. One is outflow of the rental payment. The second is tax saving from rental payments. Now the question arises, what should be the discount factor? Now listen and listen carefully. Discount factor, cost of capital for lease as well as for the buy decision must be same. It has to be same. It cannot be different. If, let's say, just an example, okay? If someone says for lease decision, the discount factor will be 12% and for buying decision, the discount factor will be, let's say, 13%. So I will outright reject the buy decision because the cost of capital is, if the cost of capital is 13% for the buy decision and for the lease, if it is 12, so it is obvious that lease is cheaper than the buying decision. So logically, the cost of capital, the discount factor for both the decision, it has to be same. And why it is same? Because we are actually comparing, should I go for the lease or buy? So logically, the final decision will be on the basis of final negative NPVs. And normally what happens, how do we buy the asset? Let's just imagine that you are sitting in a bank and the bank is the one which gives you, let's say, two options, either to take that asset on lease or to take the loan from the same bank to buy the asset. So actually you just need to decide, should I take asset on lease or should I take the loan to buy the asset? So logically the discount factor will be same in both the cases. What will be the discount factor? Let me tell you. discount factor is the interest rate on bank loan. For example, if the bank loan 10% is the bank loan, now listen and listen carefully. If there is no tax rate in the entire question, assuming if there's no tax rate in the entire question, then 10% will be the discount factor. But normally you will be having a tax rate also. If there is a tax rate, then discount factor, cost of capital will be after tax. Let's say 10% is the bank loan, and let's assume the tax rate is 30%. Now your discount factor will be simply 10%, 1 minus t, it will be 7%. So the cost of capital discount, you will be doing the discounting of lease as well as the buy at 7%. So in both the cases, that is for the lease decision as well as for the buy decision, the discount factor, the cost of capital is same, which is bank loan interest rate 1 minus t. Now, what are the factors which we are going to consider when we are going to borrow to buy? When we are going to borrow to buy. NPV of buy decision. Number one, you will take outflow of initial investment. Outflow of initial investment. Second, you will take tax savings from capital allowances. You will take tax saving from capital allowances. Third, if there is a maintenance cost, then outflow of maintenance cost. Then tax saving from this maintenance cost. Tax savings fifth, if there is a residual value, scrap value, then inflow of residual value. And discount factor will be same. That is interest rate on bank loan, simply 1 minus tax rate. You will be calculating NPV of lease as well as buy, and then at the end of the day, obviously you will be having two negative NPVs, and we are going to opt the source of finance which gives us a cheaper, which is cheaper for us. Cheaper means the source of finance which is having a lower negative NPV. Obviously, we will opt that because that source of finance will be cheaper for us. So let me save this page. Then I'm going to share one question with you. Just a minute. Let me save the page. Yesterday's all notes I have shared I think I have shared in your WhatsApp group. So FM crash. Let's take it like lecture. You can say day 2 and out one. Let me pause the video so that there's a question number 157 from your BPP kit. Should I share in the WhatsApp? So then you have to give me a time. Let me pause this. The first one, Malini. Because Malini is on the topic which we have just discussed. Assuming that the new machine is operated for 3-year period, evaluate whether Malini should use leasing or borrowing. So actually A1 we need to discuss, not the Barida. That is on another topic, which we I think have to discuss. So far we have not discussed annual equivalent cost. So let's read Malini part A1. Malini company is considering the acquisition. Recording has started. Acquisition of a new machine with an operating life of 3 years. The operating life is 3 years. The new machine would be leased for 3 payments of 55,000 obviously each, payable annually in advance. That is very important. If you're paying rentals in advance and you are paying 3 rentals, then it will take T0 will be the first rental payment time, then T1 and then T2. So 3 payments will take altogether 2 years because company is paying in advance. Alternatively, the machine could be purchased for 1,60,000 using a bank loan at a cost of 8% per year. If the machine is purchased, Malini company will incur maintenance cost of 8,000 per year, payable at the end of each year of operation. The machine would have a residual value, scrap value of 40,000 at the end of its 3-year life. Okay. Malini company's production manager estimates that if maintenance routines were upgraded, the new machine could be operated for a period of 4 years, with the maintenance cost increasing to 12,000 per year, payable at the end of each year. If operated for 4 years, the machine residual value will be 11. Look at this, they're saying ignore taxation, which means that we will show the rental payment, but tax saving from the rental payment will not be a part of answer. Why? Because examiner says ignore tax saving, ignore taxation. It means in case of borrowing and buy the project, there will be no tax saving from capital allowances. There will be no tax saving from capital allowances because there is no tax. But right now we are just solving A1. It says assuming that the new machine is operated for 3 years, just for 3 years. So it should be very simple. NPV of lease decision. Okay, any question? Yeah. NPV of lease decision. Can I say it will take 2 years to pay all 3 rentals? Rentals are 55,000 each year. Discount factor is 8%. This is one. I think 0.926. Calculate. 0.857. Present value 55. 55,000 to 0.926. 50,930. $47,135. Let's see what is the NPV. 153065. That's great. 153065. Now simply borrow to buy. T0, T1, T2, T3. Malini. 1,60,000. Can I say that is initial investment? Initial investment. Initial investment is 1,60,000. Malini will incur maintenance costs 8,000 per year, payable at the end of each year of operation. That is 8,000. What is the residual value? Residual value is 40,000. So let's calculate net cash flows. We don't have anything else. Nothing else. Discount factor 8%. 1.926. It was 0.857 then. 0.857 divided by 1.08. I'm getting 0.9. Okay, 0.794. Present value of net cash flows. $32,000. I'm getting 2.5. So 1,60,000 negative 7,408 negative 6,856 negative positive 25,408. The answer I'm getting is 1,48,856. So you can see that, can I say borrow to buy is cheaper than lease? So borrow to buy is cheaper than lease. Therefore, machine should be financed. Can I say machine should be financed by borrowing? Why? Because it is cheaper. Okay, now look at this. A2. Using a discount rate 10%. Calculate equivalent annual cost. We have not discussed so far. So we need to discuss the topic. Critically discuss 4 reasons why NPV is regarded as superior to IRR. Okay, quickly answer. We did discuss yesterday. Number 1, actually NPV is an absolute measure. The result of NPV is a value which does not mislead the stakeholders. IRR is a relative percentage which can be misleading. Another point, can I say when project is having non-conventional cash flows, then for the same project, there will be multiple IRRs. NPV does not have such issues. Another reason, when it comes to mutually exclusive projects, IRR should not be used because decision on the basis of IRR can be misleading, can be incorrect. In case of mutually exclusive projects. In fact, in case of mutually exclusive projects, decision should be made on the basis of NPV. And obviously, the project which gives a higher NPV, that will be opted. Another, if the cost of capital keeps changing every year, then it becomes difficult to calculate. It is difficult for IR to deal with that situation. When cost of capital changes every year, then it is difficult for IR to deal with that situation, but NPV does not have any issue at all. You can write other, whatever comes, whatever logical you know that you can write. Now let us quickly discuss annual equivalent cost. What is this? There's one decision. The name of the decision is asset replacement decision. Actually, in this asset replacement decision, first you need to understand one thing. The concept is, for example, let's say there's one plant and machinery. There's a plant which is having a useful life of 3 years. Assuming your company bought a plant today which is having a life of 3 years, but your company wants to use this asset forever. Now the question is, if the plant is having a life of 3 years, how can you use this plant forever? There's only one answer, that you will keep replacing it. And the company says we need this asset forever, so it means you have to keep replacing the plant with the identical asset. So when an organization is having a plant which has a, let's say, life of 4 years or 3 years, but they need to use it for forever, then they have to keep replacing it. Under this topic, asset replacement decision, we have to decide the decision, replacement policy on financial grounds, that when to replace the asset, because the simple is we are going to opt the asset replacement policy which will be cheaper. If plant is having a life of 3 years, then logically 3 replacement cycles are possible. You can replace after every 1 year, after every 2 years, or after every 3 years. If asset is having a life of 4 years, then we have 4 replacement cycles are possible. After every 1 year, after every 2 year, after every 3 year, and even after every 4 years. Now the question is, what is the name of a technique which is going to actually help you to make the decision that which replacement decision should be made? The name of the technique is equivalent annual cost. Equivalent annual cost. You're going to take the present value of one replacement cycle, present value of one replacement cycle, simply divided by annuity factor. Logically, when you are dividing present value one replacement cycle with the annuity factor, you are actually converting this answer into annuity cash flows. So equivalent annual cost, how do we calculate? All you need is just take the present value one replacement cycle divided by annuity factor. Now, obviously, if the asset is having a life of 3 years, then maximum 3 replacement cycles are possible after every 1 year, after every 2 years, and even after every 3 years. All you need is just calculate the present value of, let's say, one replacement cycle, which could be 1 year, 2 year, 3 year. It will be mentioned in the question. Then simply divide with the annuity factor. And we are going to opt, we will be making, we will opt the replacement policy where we will have lower equivalent annual cost. Now, in this topic, you need to understand two things very well. Number one, with the passage of time, the resale value of the asset will reduce. Because slowly and gradually, when your asset will get older, the resale value drops. For example, asset is having a life of 4 years, and let's say we are checking after every replace. Should we go for after every 1 year replacement, after every 2 year, 3 years, or 4 years? Resale value will be highest if you are replacing after every 1 year. And logically, resale value will be lowest after every 4 years. So logically, the asset will get older, the resale value will drop definitely. Another thing is maintenance cost. Now listen carefully. Logically, the maintenance costs can increase due to two factors. Maintenance costs can rise due to two factors. One is the age of the asset. Age of the asset. Obviously, the asset gets older, the maintenance costs will rise. You will be spending more money to maintain, to keep the old asset. So one, the maintenance cost rises with the age. Second is the inflation. Because sometimes what happens, examiner gives you the question and he says the maintenance, assuming the examiner says the maintenance cost will be just, let's say, 10,000 in year one. And then examiner says it will rise by, let's say, 10%. Okay. And at the end of the question, examiner says ignore inflation. So you are not supposed to ignore that 10% which examiner has given you. He is not saying it is an inflation. Nothing is mentioned, then I'll take it as an age impact. The older the asset will be, the more higher maintenance costs I have to bear. So with the passage of time, the resale value drops, but with the passage of time, maintenance cost increases, and there are two possible reasons to increase in the increase in the maintenance cost. One is the age, another is the inflation impact. Now, another thing is, for example, let's say we have project A with a negative NPV of, let's say we have plant A with a negative NPV of 40,000. The life is 4 years. We do have plant B. The negative NPV is 44,000. Life is 5 years. Cost of capital is, let's say, 10%. And the simple question is, we need to decide which plant should we buy. Should we buy plant A or should we go for plant B? Now listen. Directly on the basis of NPV, we cannot make the decision because the lives are not comparable. One is having a life of 4 years, another is having a life of 5 years. So what do you have to do? Simply, you need to calculate equivalent annual cost of each plant. Equivalent annual cost. If I take plant A, 40,000. At 10%, when the life is 4 years, the annuity factor is 3.17. So 40,000 divided by 3.17, it results in 12,618. If I go for plant B, equivalent annual cost 44,000. When the life is 5 years, cost of capital is 10%, the annuity is 3.79. Equivalent annual cost is 11,609. So I'll go towards plant B because it has a lower cost than plant A. Now, assuming, let's take the same question and we have project A with a positive NPV of 40,000. Life is 4 years. Project B with a positive NPV of 44,000. Life is 5 years. Now we need to decide which project should we opt. Now you will be calculating equivalent annual benefit. Earlier we calculated equivalent annual cost. Directly you cannot make the decision on the basis of 40 and 44,000. Why? Because the lives are not comparable. So to make them comparable, we are calculating equivalent annual benefit. 40,000. Let's say the cost of capital is same, which is 10%. I'll divide this with 3.17. So 40,000 divided by 3.17, I'm getting positive, obviously 12,618. And equivalent annual benefit, obviously 44,000. Divided by 3.79, we will have 11,609. Can I say now we will go with project A? Because project A is actually giving us a higher equivalent annual benefit. So when you want to make a decision, let's say which project should I opt, but the lives are not comparable, then you have to calculate equivalent annual benefit. when you have two plants in front of you, you want to buy one, and both are having obviously negative NPVs, but the lives are not comparable, then you'll be calculating equivalent annual cost, and then you will be buying a plant which has a lower equivalent annual cost. Sometimes this topic can be examined like this. Otherwise, normally this topic is examined in a normal pattern. The normal pattern is there's a project, there's a plant, let's say, which is having a life of, let's say, 3 years, and you need to make, entity wants to make a decision, should we replace after every 1 year, after every 2 year, or after every 3 years? That's a normal way of asking the question. But examiner can ask this variety, which I've just discussed with you. Now let's come back to the question. Now, A2, what it says, using a discount rate 10%, calculate equivalent annual cost of purchasing and operating the machine for both 3 years and 4 years, and recommend which replacement interval should be adopted. Now, you should understand the question, what he's saying. The question says, using the discount rate 10%, calculate the equivalent annual cost of purchasing and operating the machine for both 3 years and 4 years. It means we'll be calculating first NPV of the buy decision for 3 years, but this time we'll not be using the discount rate 8%, we'll be using the discount rate 10%. Then we need to calculate NPV for 4 years. Let us first calculate NPV for 3 years. A2. So 3 year replacement. 3 year replacement cycle. T0, T1, T2, T3. We need to buy, so initial investment is 1,60,000, if I'm not wrong. You have to write the complete initial investment is 160. Maintenance cost. Maintenance cost is 80, resale value is 40, okay? Maintenance cost is 8,000. Resale value is 40,000. There's no other cash flow. Now discount rate, instead of 8, it is 10%. $1.909, 826.751. Present value of net cash flows. 8,000 into 0.909. $32,000. Present value of 3-year replacement cycle. I'm getting 1,49,848. Now, annuity factor for first 3 years at 10%. Let's see what is the annuity factor. I'm getting 2.4868, so you can make it 7. Equivalent annual cost 1,49,848 divided by 2.487. Let's see what is the answer. 1,49,000. 1,49,848 divided by 2.487. I'm getting 60,253. I'm getting 60,253. Now let's go for 4 years. Four-year replacement cycle. T0, T1, T2, T3, T4. Initial investment is 1,60,000. Something relating to maintenance is mentioned in the question when we go for 4 years. Malini Company's production manager estimated that if the maintenance routines were upgraded, the new machine could be operated for a period of 4 years. Maintenance cost increasing to 12,000 per year, payable at the end of each year. If operated for 4 years, then the residual value will be 11,000. So now the maintenance will be 12. RV will be 11. Maintenance cost is 12. Residual value was 11. Net cash flows 1,60,000. Our discount factor is 10%. That's favorite. 1.909. 0.826751683621 and so many others. Okay, now just present value of net cash flows. 1,60,000. Okay, 10908. 10908. 9912. Okay, students on pause. 9012. What is the last one then? 683. Excellent. Let's take the total present value. What is the total? Can you tell me quickly, please? 160. 190,515. 190,515. So equivalent annual cost at 10% for 4 years, it is 3.17. Annuity factor is 3.17. One nine zero 515. 3.17. 60,099. 60,099. Yes. Let's see what is the answer for every 3 years. Oh. Every 4 years is cheaper. Yes or no? Every 4 years is cheaper. So recommendation is every 4 years. Every 4 year. Replacement cycle is cheaper. So organization should go for every 4 year. Okay, just a minute. Let me save this page and then I'm going to share a question on expected value of NPV. Let me first save this. Just a minute. Okay, copper company, it came the way back March, June 2018. I would say before the COVID. This question came using joint probability, calculate the mean expected NPV of the proposed investment, 8 marks. Okay. Calculate the probability of the investment having a negative. What is the probability that NPV will be negative? Calculate the NPV of most likely outcome and comment on financial acceptability of the investment, proposed investment. Let's read. Copper company is concerned about the risk associated with the proposed investment and is looking for ways to incorporate risk into its investment appraisal process. The company has heard that probability analysis may be useful in this respect, and so the following information relating to the proposed investment has been prepared. Now you should be able to read the data very well. If you can read the data very well, the interpretation of the data, if you know, then you can easily tackle this question. Otherwise, this question is going to disturb you. Look at this in year 1, the cash flow. I'm just ignoring 3 zeros. Let's say I'm reading it 1,000, 2,000, 3,000. So cash flow could be 1,000. It has a probability of 10%. Cash flow could be 2,000, which has a probability of 50%. Cash flow could be 3,000, having a probability of 40%. Okay. Now look at the year 2. In year 2, I'm just again ignoring 3 zeros for the sake of simplicity. Actually, in year 2, There are 30% chances that the cash flow is going to be 2,000. There are 60% chances cash flow will be 3,000. We have 10% chances that cash flow will be 5,000. Now, what is important? Try to understand that. See, if in year one, the event of 1,000 occurs, this event, which has a probability of 10%. Then in year two, there are three possible outcomes. In year two, there's a possibility of 2,000 as well as 3 as well as 5 with their respective probability of 30%, let's say 60% or 10%. If in year one, if this event happens, the 2001, which is having a probability of 50%, then if in year one, this event happens, then in year two, again, there are three chances. Three outcomes are possible. That is 2,000 with a probability of 30%, 3,000 with a probability of 60%, 5,000 with a probability of 10%. Third, if in year one, the event of 3,000 cash flow occurs, which has a probability of 40%, if in year one, 3,000 cash flow comes, which has a probability of 40%, then in year two, again, there are three possible outcomes with their respective probabilities. Either it can be 2,000 with a probability of 30%, 3,000 with a probability of 60%, 5,000 with a probability of 10%. Now listen and listen carefully. There are 9 possible outcomes. Look at this. Let me change the color of the pen. There are 3 outcomes in the second year. 3 more makes it 6, and so logically there are altogether 9 outcomes. Okay. Now what else? However, the company is not sure how to interpret the results of the investment appraisal based on the probability analysis. The proposed investment will cost 3.5 million, means 3,500 because we have ignored 3 zeros. Payable in full at the start of the first year of operation. Copper uses a discount rate 12%. Excellent. There's a discount factor available also, which means that if I'm having a discount factor of 12%, look at this. In year one, the factor is 0.893. By multiplying these cash flows with 0.893, I'll get the present value. Over here, it will be 0.797. So it means we have to calculate present values as well. If I just use the calculator to save the time, so 1000 to 0.893, it will be 893. 2000 into 0.893, I'm getting 1786. 3000 0.893, I'm getting 2676. Now 2000 into 0.797, I'm getting 1594. So 3000 into 0.797, 2391. 5000 into 0.797. Since discount factor is given, so we have to calculate the present values as well. We have calculated. Now the main thing is, while answering how you will formulate this, that is very important. At least one thing should be clear to everyone, that is, in the second year altogether, there will be 9 outcomes. There will be 9 outcomes. Now, how we are going to calculate expected value of NPV, let me tell you. Expected value of NPV. Look at this. I'm just ignoring 3 zeros for the sake of simplicity. Simply, I'm taking cash flows in year one. Obviously, we'll be working on present values of cash flows. So, cash flows in year one. Just a minute. Cash flows in year one. In present value terms, okay? Their probability. Then cash flow in year two. In present value terms, probability. Then I'll be having total cash flows. Total cash flow means year one plus year two. Then we'll be having a joint probability. How do we calculate joint probability? By multiplying probability of year one with year two. Joint probability. Then finally, we will be having expected value. We'll be having just EV. Expected value. So present value of cash flows in year one. Now listen. If in year one, the event of 893 occurs, now please try to understand. If this event occurs in year one, which has a chance of 10%, then in the second year, there are three possibilities. There's a possibility of 159423913985. So look at this. 893, which is having a probability of 10%. Then in the second year, there are three possibilities. The possibility of 1594 2391 3985. Each one is having their respective probabilities 30%, 60, and 10. So if in year one, the event of cash flow of 893 in present value terms occurs, which has a chance of 10%, then in the second year, actually, there are three possible outcomes. So just for the sake of simplicity, you can repeat this. So if you can make first four columns, then rest of the three column depends on the first four columns. How will you calculate the total cash flow of year one, year two? Just you need to add cash flows of year one with year two, which means that 893 plus 1594, I'm getting 2487. 893 plus 2391, I'm getting 3284. 893 plus 3985, I'm getting 4878. How do we calculate joint probabilities? By multiplying these two probabilities, this with this. 0.03. 0.1 into 0.6, 0.06 and 0.01. Last column, how will we calculate last column? Just multiply these two columns, the total cash flows of year one, year plus year two with joint probability. 2487, or you can do this for your easiness. These are the two columns, I'm multiplying them. 2487 into 0.03. I'm getting 74.61. 3284 into 0.06. I'm getting 197.04. So take it 197. 4,878. 48.78. Now in the second year, what happens? Now, if in the first year the event of 1786 occurs, because the cash flow of 2000 is having a present value 1786, with the probability of 50%, 1786, 1786, probability is 50%. If this event occurs in year 1, then in the second year again there are 3 possibilities. In the second year there could be 1594, 2391, 3985 with their respective probabilities 0.3, 0.6, 0.1. Now just repeat it. I would say the same thing again. If you have made first 4 column, then rest of the 3 should not be bothering you at all, because rest of the 3 columns actually they depend on the first 4 columns. So 1786 plus 1594. I just added these two. I'm getting 3,380. Now add 1786 with 2391. I'm getting 4,177. Now add these two. So 1786 plus 3985. 5771. Now the joint probabilities. Let me change the color. How will we calculate joint probabilities? 0.5 multiplied by 0.3. 0.15. 0.15. 0.5 into 0.6, 0.3. 0.5 into 0.1. How are you going to calculate last column? Just multiplying these two columns. So 3,380 multiplied by 0.15. 507. 4,177. I'm getting 1253.1. 5,771 into 0.05. 288.55. Now the last one was, if the event of 3,000 occurs, which has a probability of 40%, the present value is 2679. 2679. If this event occurs, which has a present value of 2679 in the first year, then again in the second year, there are 3 outcomes, 3 possible outcomes. 1594, 2391, 3985. With their respective probabilities. Copy paste this one. Now, again, the same thing. If you have made first 4 columns, then rest of the 3 columns logically should not disturb you. Just add present value of year 1 and year 2. So 2000. Now what I'm doing, I'm just adding these two. 2679 plus 1594. I'm getting 4273. Now add these two. 2679 plus 2391. I'm getting 5070. That's great. 2679 664. Okay. For joint probabilities, we just need to multiply them. I'll get 0.12, 0.24, and what is the last one? 0.04. This is 0.04. Now simply multiply this. So 4273 into 0.12, I'm getting 512.76. 5070 into 0.24. I'm getting 1216.8. 6664 into 0.04. 266.56. Now let's see what is the present value total of this expected value. You will have the sum of present value of EV. $74.61 plus 197 plus 48.78 plus 507 plus 1253.1 plus 288.55 plus 512.76 plus 1216.8 plus 266.56. I'm getting 4,365.16. 4,365.16. Less the initial investment, which is 3,500. Here comes the expected value of NPV. $865.16 positive. So the expected value of NPV is 865.16. Now, other requirements are extremely important because they depend on this column which we have made. Look what it says. Calculate the probability of the investment having a negative NPV. Then what is the probability that NPV will be negative? Now listen, and listen carefully. Actually, if you see the column of total of cash flows of year 1 and year 2, there are altogether 9 outcomes. But logically, they will out instead of 9 outcomes, practically there will be only 1 outcome. You will not be having actually 9 outcomes. So the total of cash flow of year 1 and year 2, we have taken sum of these cash flows 9 times. But once you have made an investment, there will be only 1 outcome. There won't be 9 outcomes. Now, please try to understand. For example, if let me change the color. If the first total comes only this 2487, nothing else. Now please try to understand. 2487, if I deduct minus 3500. So logically, I am going to have a negative NPV. So the first one, if this comes, then NPV is going to be negative. Second, 3284. Even the second event happens, which is 3284. If I deduct 3500 from here, again, I'm going to have a negative NPV. Now, look at this one, 3380. If the event of 3380 occurs, if I deduct 3500 from here, again, I'm going to have a negative NPV, which means that there's no other any event which results in negative NPV. Now listen, which means that what is the probability that NPV will be negative? We have to add the probabilities of these three outcomes. Joint probability 0.03, 0.06, and 0.15. 0.03 plus 0.06 makes this 0.09. If you add 0.15, it becomes 0.24, means 24% probability. So 2487 minus 3500 results in negative NPV. This is the one event. Second is 32. That also results in a negative NPV. So we have just added the joint probabilities. 0.03 plus 0.06. Or you can say 24% chances. There is 24% probability that NPV will be negative. So simply there is 24%. There is 24% probability that NPV will be negative. What is the other requirement? Calculate the NPV of the most likely outcome. Actually, most likely outcome means look at the joint probability. Which event is having the highest joint probability? Can I say this is the highest joint probability, 0.3, which means 30%. You can check any other event. All other events are having probabilities lower than this one. The most likely outcome is having a probability of 30%. Most likely outcome means the outcome which has a highest probability. It is 30. It means at 30%, the present value is 4177. Which means that NPV at most likely outcome, which is 30%. 4177, can I say minus 3500? So you'll get, what are we getting? We will be getting 677. Okay. Comment on the financial acceptability of the proposed investment. Now listen and listen carefully. Normally, the outcome which expected value gives you normally does not happen. Another point is when you are working on expected values, actually expected values, they hide risk. How? Look at this. We are having a positive NPV of 865.16, even though there is 25%, 24% probability that project can generate the negative NPV. But if you are making the decision on the basis of expected value of NPV, which is positive 865.16, so this actually will hide the risk as well. So in this project, actually, there are 24% chances that project is going to have a negative NPV rather than the positive NPV. So whatever the outcome expected value basically suggests, normally it does not happen. Another thing is expected values, they hide risk. Another thing is expected values are actually long-term averages. And normally the accuracy of expected values itself is challenging. Why? Because normally the expected values we use in a scenario which is a repetitive in nature. When it comes to investment appraisal, most of the time the investment appraisal projects are one of the decisions. We are not repeating it again and again. So which means that making decision on the basis of expected value, organization has to consider the limitations of expected values. Not blindly they make decision since expected value of NPV is positive, so we make investment. No. They should not be doing this. They should be considering limitations in expected values of NPV. They should not be making the blind decision. Is this clear to everyone? They should not be making the blind decision. Yes or no? Now listen. Let me show you. How did we calculate this? Just to calculate this expected value of NPV, we did this. We made seven columns. Yes. Then we finally calculated this 865.16. Now let me show you the shortcut. There's no need to write shortcut, just expected value of NPV is equal to, in the first year, the event of 893 can happen, which is having a probability of 10%. 893, keep watching, please. 10% plus. In the first year, 1786 can also come. 1786 with a probability of 50%. In the first year, there could be 2679 with a probability of 40%. Now let's go for the second year. Second year, there's a possibility the cash flow 1594 can come with a probability of 30%. 1594 with a probability of 30%. 2391 with a probability of 60%. Three 3985 with a probability of 10%. 39. Just use the calculator, please, every one of you. Please use the calculator. The magic is going to be in front of you. I'm having 4365.2 minus 3500, which is the initial investment. $865.2. 865.16. Look at this. Now the question is then, why did we go for a very long method? Because of the other requirements. Because of the other requirements. So I hope you people must have enjoyed this question. Yes or no? Okay, just one thing, then we'll be ending the class. Actually, I myself personally, I teach PM. Previously, we used to say F5. I also teach tax. Previously, that is F6. I'm teaching FR. Previously, we used to say F7. I'm teaching FM. Right now, I'm conducting the crash course, which is SBR. Old name is P2. AFM, old name is P4. And ATX, old name is P6. And Alhamdulillah, I have produced position holders in each and every paper. Alhamdulillah. And not only I have produced position holders in each and every paper. In fact, these are the two papers in which I have in fact produced world positions. In F9 and P4, my students, they have taken world positions as well. So in each and every, in taxation paper, one of my student, she took 99 marks. So in each and every paper, alhamdulillah, I have produced position holders. Tomorrow, inshallah, I'm just telling you, inshallah, tomorrow we'll be discussing, inshallah, cost of capital. Tomorrow we'll be discussing, inshallah, cost of capital. I just want to write my admin number. For outsider students, if anyone wants to in contact with Abeel School of Accountancy, ASA admin. For outside Pakistan, the WhatsApp number is 00923333666214. That is ASA admin number. Those they are within Pakistan, 0333366214. So inshallah, we'll be discussing cost of capital tomorrow. So thank you very much that you people have taken out the time to attend the live crash class. Thank you very much, and every one of you, and those that are listening this on my YouTube and they're listening later on. Every one of you should have a nice, you should have a nice life, inshallah. Inshallah, have a nice life. Thanks a lot.